Welcome to the Stock Market Palantir. Today, we are going to talk about DFLI, Dragonfly Energy Holdings Corp. Is a company that has offered a masterclass in extreme stock volatility over the past few months. What makes it so complex is its dual identity. It's an established operational leader, known for its reliable battle-borne batteries and strong OEM channel growth, but it has simultaneously operated as this speculative pre-revenue tech venture, constantly hampered by a deeply distressed and frankly volatile balance sheet.
And that collision of identities is precisely the issue, isn't it? The wild, almost violent price action we've seen recently is the market reacting in real time to a rapid and incredibly painful financial transformation. We're not just debating a stock, we are debating the immediate aftermath of corporate surgery.
Precisely. So the central question for us today is this. Has DFLI's comprehensive financial restructuring successfully transitioned the company into a stable, high-growth entity ready to execute on its technology potential? Or does the history of severe dilution and existential financial distress still impose a permanent definition on its intrinsic value and its risk profile?
I come at it from a different angle. I'll be arguing that while the underlying operations, yes, they show promise, the sheer crippling cost of this survival, I'm talking about the massive, inescapable dilution inflicted on shareholders, has fundamentally and permanently reset the baseline for what you can expect in terms of value. The structural risks that come from that financial weakness, well, they remain the central defining factor for me.
And I'll take the opposing stance. I believe management has finally completed its necessary corporate cleanup. They have surgically eliminated the existential threat of debt default and NASDAQ non-compliance, allowing the market for the first time, really since this SPAC debut, to price in the strong underlying business and the future potential of their dry electrode technology without that constant shadow of bankruptcy hanging over everything. So let me start by outlining the evidence for DFLI being fundamentally de-risked. The key event was that definitive term loan restructuring announced on November 5, 2025. Now, this was not a Band-Aid, it was surgical. Management strategically used the cash they secured from the prior October offerings to completely rewrite the balance sheet. They prepaid $45 million in principal, which drastically reduced immediate liabilities.
That is undeniably a major move.
It's more than just a move. Crucially, they converted $25 million of principal into a newly created preferred stock and had $5 million of outstanding principal completely forgiven. This entire process reduced the total outstanding principal from $94 million down to just $19 million. This action removes that going concern risk that plagued the stock for months. But you can't separate the financial cleanup from the operational proof we saw in Q3 25.
Okay, tell me about the operations.
Q3 demonstrated real core strength. Net sales grew 25.5% year over year to $16 million. More importantly, OEM sales, which, signify long-term embedded growth channels, they surged 44.3% year over year to $10.7 million. And look at the margin expansion. Gross margin expanded significantly by 710 basis points to 29.7%. This operational proof, combined with a clean balance sheet, is the only rational path forward.
Okay, I agree that the operational metrics are strong, but that strength came at an unacceptable cost. The severe, dilutive price paid for the survival fundamentally dictates the conversation about shareholder value, irrespective of those margin gains. We have to look at the history of distress that necessitated this action in the first place. This company has used reverse splits as a kind of metronome marking chronic financial weakness. You had a 1-for-9 reverse split in November 2024, followed less than a year later by the authorization for a potential 1-for-50 split in October 2025.
That authorization was purely a strategic tool, though.
I see why you'd think that. But that pattern speaks to a chronic inability to sustain a compliant stock price organically. And look at the scale of dilution required to fund that debt cleanup you just praised. The number of shares outstanding, it ballooned from 7.2 million in December 2024 to 61.7 million by September 30, 2025. And that trajectory was before the huge capital raises in October, including the $55.4 million public offering. The stock's collapse was a direct result of this financial reality, not some failure of their battery technology. This financial damage is the defining risk factor today.
That's a compelling argument regarding the historical damage. I'll grant you that. But I would frame it differently. The market is attempting to reconcile the end of that toxic debt era with the start of an execution era. And nowhere is that conflict clearer than in the Q3 2025 earnings release, which is our first point of contention. The massive beat on analyst consensus EPS estimates, reporting a net loss per share of -20 cents versus estimates as low as -71 cents, combined with that surging operational growth, especially the 44.3% OEM growth, clearly show the operational turn is already in place. Management's newfound confidence in, quote, playing offense is entirely justified by the underlying efficiency, specifically that 710 basis point jump in gross margin.
I appreciate that focus on the leading indicators. I really do. But the market saw two conflicting headlines on earnings day, and the most frightening one was that the GAAP net loss widened to $11.1 million. That net loss is what retail and, let's be honest, many institutional investors focus on. That $11.1 million is a crucial lagging indicator because it contains $6.4 million in crippling interest expense. This interest was generated by the old debt structure that existed throughout the entire third quarter before the restructuring closed in November. The market struggles intensely to price this disconnect. How does a sophisticated investor definitively rationalize that number? It just proves the financial ghost of the past is still actively influencing current perception and pricing, even if those costs are technically gone now.
Sophisticated investors can filter that noise, though. They understand that the GAAP net loss headline was noisy because the restructuring occurred after the quarter ended. They look past that one-time timing issue. The real story is the operational efficiency. A 710 basis point expansion means that for every $100 in sales, the company is capturing an additional $7.10 in gross profit compared to last year. That is fundamental proof of improved cost of goods sold, better procurement, manufacturing maturity. That efficiency translates directly into future free cash flow, unlike the debt obligation, which is now largely extinguished.
I accept that the interest expense is a non-recurring headwind, but the lingering issue is the market structure itself, which brings us to our second point of contention, the role of short sellers and volume dynamics. The retail narrative often fixates on dark pools, and while we should clarify terms, dark pools, off-exchange volume reported by FINRA, volume-weighted average price, the data suggests ongoing massive speculative flow. For instance, the high off-exchange activity exemplified by November 14 having, 54% short volume of all off-exchange trades suggests persistent, massive selling pressure, regardless of whether you label it manipulation or just hedging.
That is a very precise reading of the flow metric, but focusing solely on short volume, a daily measure of activity, completely overlooks the seismic shift in short interest, which is the measure of committed positions. The entire short squeeze narrative from October is a red herring now. The shorts were in fact correct in their initial bearish bet. They bet on dilution or delisting when the short interest was 15.38% in early October.
And they were handsomely rewarded by the collapse, yes.
Exactly. But they covered when the massive $55.4 million dilution was announced because their thesis was executed. This caused short interest to collapse to a relatively benign 4.86% by November 7th. That low percentage indicates that the sustained bearish pressure is mostly gone. The high off-exchange volume you point to now is simply market makers and high-frequency traders providing liquidity and managing risk amid this extreme price volatility. It is a technical footprint of chaos, not the fundamental cause of a bearish outlook. The cause was the balance sheet, which is now largely fixed.
Fixed, yes, but at what cost? And this brings us directly to our third point, the strategic necessity versus the sheer desperation of these corporate actions, specifically that reverse split authorization. You framed the threat of the 1-for-50 reverse split authorization as some kind of brilliant strategic mechanism. They secured stockholder approval on October 15th, which immediately leveraged the $55.4 million offering the next day, using the compliance risk to force the required capital raise.
It was painful, yes, but it was effective crisis management. They used the worst-case scenario, the potential 1-for-50 split, as leverage to ensure they secured the liquidity needed to execute the debt cleanup, thereby removing the need for the split entirely. They threatened the sword to save the patient.
I'm sorry, but I just don't buy that it was smart maneuvering. Requiring authorization for a 1-for-50 split less than a year after completing a 1-for-9 split demonstrates a chronic and fundamental inability to maintain a stable capital structure and a profound lack of faith in the organic stock price. That is systemic failure, not just bad luck. This pattern traps long-term investors in an endless cycle of dilution and adjustment. That retail sentiment we see, investors ECAing to get my cost basis down, is the physical manifestation of that financial harm. It's real investor capital continuously being absorbed by the necessity of survival, irrespective of the management's competence in a crisis. You cannot escape the economic reality that 61 million plus shares require significantly more operating success to move the needle than 7 million shares did a year ago.
The harm is acknowledged, but the crucial takeaway is that the crisis ended with the November 5th restructuring. The company has reset the clock. The pain was upfront, and now the business is free to grow. The question is, does this cleared balance sheet give them the runway they need to achieve the next phase, which is funding the dry electrode technology transition? The newly cleared balance sheet is absolutely essential for shifting management focus and capital expenditure towards scaling dry electrode R&D and eventually mass production. The $25 million conversion into a preferred stock is key here. That preferred equity signals long-term institutional faith. It is patient capital that doesn't demand immediate cash return and provides a stable capital base required for a multi-year technology rollout. This is the difference between a survival mechanism and a growth strategy.
I appreciate the positive spin on the preferred stock, but the numbers still look tight. They still have $19 million in debt remaining, and the Q3 report showed a widening net loss, even if we adjust for the interest expense. Is that remaining capital structure really sufficient to fund the expensive transition from traditional lithium-ion, which generates their current cash, to the massive capital expenditure required for new dry electrode manufacturing facilities? The company's history suggests that if they hit significant technology milestones, they will use that success as leverage for another highly dilutive equity raise, because the cost of building out that dry electrode capacity globally will easily exceed the capital they raised in October. The balance sheet is cleaner, but it is not yet robust enough to fund their ambitious technological future without requiring continuous, painful infusions of shareholder equity.
I think you are overlooking the flexibility that comes with the debt terms post-restructuring. They now have access to cheaper capital and better credit terms precisely because the foundational risk has been removed. Furthermore, the operational cash flow from Battleborn and the OEM channel growth provides the stable base of operations that technology companies desperately need while developing their future products. They no longer face the daily threat of debt covenants limiting their ability to invest. That is an enormous strategic advantage.
It's an advantage, but one built on highly inflated equity that has severely punished loyal investors. You focus entirely on the efficiency of the surgical procedure. I'm focusing on the amount of blood that was spilled.
The operation was successful and the patient is recovering.
The patient is alive, but the scars are deep and the recovery is subject to constant financial headwinds.
I maintain that the fundamental, operational, strong OEM growth and crucial margin expansion has been decisively validated by the Q3 report, and the successful debt restructuring removed the overwhelming going concern risk. For the first time as a public company, DFLI has a clean runway to focus entirely on its future technology and scaling.
And I'll reiterate that while the underlying business may be sound, the sheer volume of the dilution required, combined with the necessary drastic corporate actions, imposes a long shadow and a heavy structural cost on future returns. Investors must weigh the potential technology growth against the established pattern of painful financial maneuverings that may not be over simply because this particular debt crisis is past.
Ultimately, the market is attempting to reconcile two intensely conflicting realities in real time. The old DFLI, defined by toxic debt and constant dilution, and the new DFLI of de-risked operations and expanding margins. The resolution of that intense battle between narratives is what we will all be watching moving forward.
That battle is what we are watching unfold. The data shows both strength and fragility simultaneously.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.